Good morning, real ECN listeners. Today is Monday, 20th January 2014. I hope everybody had a relaxing weekend and ready for this trading week. This is your Forex market commentary brought to you by Real ECN. Hopefully, this commentary can give you insight into formulating your own trading strategy. If you're trading the dollar-yen cross, it will fit in line with today's discussion. First of all, we're going to explore the dollar-yen market. On the technical front, the dollar-yen cross opened today's Sydney trading session in a narrow consolidation range between the 104.4 and the 104.2 marks set by last week's trading momentum after ending last week's trading session near pre-farm, non-farm payroll level. Technical recommendation on the dollar-yen cross signal a sell since the spot price on the hourly chart opens today's trading session below the 5, 10, 20, 30, and the 40 simple moving averages. The correlative nature of the dollar-yen direction can be best described by the direction of the long-term U.S. Treasury yield curve, then the direction of the dollar index itself. Elliott wave signaled near-term correction between the 104 to 103.5 level with the expectation that the market will bounce back, breaking the 105 resistance in the wave upward. This Elliott wave count in the dollar-yen forecast rally will only come true if the long-term U.S. Treasury also rally as well. Trading entry point recommendation based on Elliott wave at 104 with stop loss at 103. Analysis of a collection of technical indicators on the hourly chart on the dollar-yen market suggests a temporary bearish market sentiment and recommend short position on the greenback. The hourly chart established a short-term Fibonacci resistance at 104.43 and an upgrade expectation that the pair will break below the Fibonacci support at 104.23 when Tokyo's trading session commenced, underlying more market participation volume and a momentum pickup. So let's closely explore the technical indicators. Over here, we have the hourly time interval. First of all, we have the RSI, which is the momentum oscillator. Right now, the price value of 46.885. So around 50, it just indicates that the momentum is really weak with technical recommendation of a neutral. That explains the consolidation range that the dollar-yen is struggling to break out. Moving down to notches, we have the MACD, which is the moving average conversion divergence. With 12 days, EMA is below the 26-day EMA right now with a price value of minus 0.050 and technical recommendation of a sell. Moving down one notch, we have the ADX, which is the average directional index. So it has a price value of 17.827 with technical recommendation of a neutral. Remember, if the price value of ADX sits between 0 and 20, it is ranging. That explains the consolidation range that the dollar-yen market is experiencing right now. And if it exceeds the 20 mark, it just shows that the trend is really strong. So moving down two notches, we have the CCI, which is the Commodity Channel Index, a confirmed buy or sell signal. A strong sell is sitting around the minus 100. Right now, it has a price value of minus 87.5910. It's still in the sell signal, but it's not that strong. So lastly, we have the bull to bear power ratio. It has a price value of minus 0.095. It means that the bear have the upper hand with technical recommendation of a sell. So total technical consensus, we have a sell backed up by 2 buy, 6 sell, and 2 neutral. Moving on to the fundamental discussion, one important risk event this week that can present itself as market moving catalyst for the dollar-yen market would be Wednesday BOJ meeting regarding benchmark rate and setting the underlying tone for monetary policy in 2014. Over the past year, the aggressive nature of the BOJ and the Abe's administration towards fighting deflationary pressure that have been haunting Japan for the past 2 decades have made the yen the worst performing OECD currency in 2013. Therefore, significant emphasis are being placed on this upcoming BOJ meeting, as any signaling to the market by the BOJ with tightening rhetorical of any sorts can ultimately cause the dollar-yen cross to reverse all the gain it had made over the past year. However, market consensus expects the BOJ to remain dovish on its monetary policy standpoint despite core inflation touching 5-year highs. The implementation of an increase in Japanese sales tax for 2014 can prompt the BOJ to remain accommodative to support domestic consumption. In the case that the BOJ governor, Kuroda, perceived that this increase in sales tax can hinder the growth of Japanese CPI, this can eventually translate to speculators upgrading the expectation that the BOJ will continue to remain accommodative for the foreseeable futures in order to meet its CPI target of 2%. This action alone is enough to build the bullish momentum for the dollar-yen pairs moving forward. The relative monetary differential between the policies of the Fed and the BOJ have been the driving force underlying the recent long-term dollar-yen rally. Unlike Japan, whom central banks have been dovish towards its policy to support sluggish Japanese economic growth, the U.S. economy, on the other hand, has been gaining traction significantly with its recovery story. The Fed's tapering action back in December last year was validated by numerous upbeat economic releases, with one hiccup exception, and that is the U.S. non-farm payroll missing market consensus by a large margin. Now, with the transition from the Bernanke's Fed into the Yellen's Fed, the market is now awaiting more signal from the new Fed with regard to her interpretation on the recent economic releases and her future tapering action. Market conditions are set up for the upcoming FOMC meeting on the 29th of January. Both dovish and hawkish voting members collectively share one similar view, and that is the economy is growing. The housing market has been recovering at a promising pace, and with unemployment rate falling close to the Fed's target rate of 6.5%. Therefore, continuing the reduction of its QE program is highly sensible. The bullish momentum underlying any currency pair is highly correlated to its central bank hawkish and dovish standpoint. Right now, the market will continue to upgrade greenback sentiment to bullish as the Fed remains hawkish towards scaling back its stimulus program amidst the backdrop of the BOJ dovish easing policy.